Okay. So preference share. What do you mean by a preference share? Anyway, what is mean by share? Share. Share represent what? The entitlement of the company. The entitlement of the company, right? So then preference share. If we are discussing about the preference share, we know if it is a company, they are a legal entity. They have a separate legal ownership. If they are a separate legal ownership, they have what they can do. In raising the capital, they can convert or they can transfer this company's the equity or the entitlement towards the potential investors. One of the way is converting the equity type or the entitlement of the company towards the potential investors is issuing a one financial instrument we called as a share, right? Share. So then shares, there are two types of shares. But these two types of shares are preference shares and the other one ordinary shares, right? Preference shares, what we call as equity shares, right? Equity shares, or sometimes we can name it as a common stock also. Then preference shares, we call sometimes it as a preferred stock. Preference shares and preferred stock. What is the importance of the preference share? Or is what are the differences in between ordinary share and the preference share? Yes. Ordinary share versus preference shares. Exactly. Dividends. Dividends. If you are coming to the dividend point, both shareholders are entitled for the dividend. But preference shareholders, they have a fixed rate of payment for the dividend. As a company need to declare definitely the dividend for the preference shareholders. That is must. Sometimes it might be in rupees, it might be in 5% or with the percentage. And then what else? Regarding the ordinary share, do they have a fixed type of dividends? No, they are entitled for the dividend, but they do not have a fixed type of dividend, right? If the company has profit, from the extra profit, what the company can do is company can share the part of that profit among these shareholders. Yes, we are discussing what preference shares. The differences between preference share and the ordinary share. Preference shares. Preference shares, fixed dividend, and then ordinary shares, they do not have the fixed dividend, but they are entitled for the dividend if the company declare the dividend. Because of what? Based on the decision of the board of directors, right? Board of the directors are the persons who are deciding whether we are going to allocate the extra profit among the shareholders. What else? Exactly. Voting powers, right? Preference shares. Do they have a voting power? No, right? But ordinary shareholders, they have voting power. So then these are the sum of differences in between the ordinary shares and then the preference shares. We'll take it out. I have just started the lesson and then you all can take down the heading preference shares. Or Ordinary share. And the other one, preference shares. Even the tube started with the ordinary share, I have started with the lesson with the preference share because there is a reason. Ordinary shares, voting power. They have voting power, but for the preference shares, they don't have the voting power. Ordinary shareholders, they do not have fixed dividend. And then preference shares, they have fixed dividend. Fixed dividend. So as a part of our discussion, we identify ordinary shareholders, they are the real owners. Real owners of the PLC or the company. Right? Preference shares, it's a hybrid mode instrument. Hybrid mode instrument. It has debt characteristics plus debt characteristics plus equity characteristics. I just write it here. Debt plus equity characteristics. Equity characteristics. Both of these instruments, right, involving where? In raising capital. Raising capital. When we are raising the capital, we can issue what? Issue ordinary share as well as the preference share. But the decision is up to the CFO as well as the finance team, whether are we going with this time preference shares or the equity. That is based on the company's requirement as well as we have to value it as well, right? That decision need to be valued. We have that lesson called the capital structure decision, debt financing and then the equity financing. Okay. So some other differences as well as similarities we have discussed. Then we move to the valuation. valuation. So we know valuation means, right? Valuation means what? Identifying the which value? Intrinsic value, right? Identifying intrinsic value is the valuation, the way of taking the value. What do you mean by intrinsic value? What do you mean by intrinsic value? Present value of future cash flows. Present value of future cash flows. Same technique, same basis applies to preference shares also. Right? Even not preference shares, ordinary share also the same basis. But there are some ordinations as well as deviated points. We discuss those things in the ordinary share lesson. If it is a preference share instrument, there are two types of preference shares. Some preference shares, they have a maturity. Whereas some of the preference shares, they do not have a maturity. Some preference shares, they have a maturity. They have a maturity. Maturity means what? We have a we are as a company, we are going to release that collected funds back to our investors. Right? It has a maturity. We call that type of shares, preference shares as redeemable. Nidahas kala haki. Redeemable preference shares. The other type is that type of preference shares, it doesn't have a maturity. It doesn't have a maturity. That means after collecting the funds, companies do not have a plan to release this collected funds to the investors. We call that type of preference shares as which preference shares? Not redeemable. It can't be redeemed, then it is irredeemable preference shares. Redeemable preference shares and the other one, irredeemable preference shares. Redeemable means with the maturity. Irredeemable means without maturity. That is what we have to again understand as a basic point. Types of preference shares. Types of preference shares. First one, PS, preference shares with maturity. The other type, preference share without maturity. If it is as a maturity, we call that type of preference shares as redeemable. Redeemable preference shares. If it doesn't have a maturity or without maturity, it can't be redeemed. Then we call that type of a preference shares as irredeemable preference shares. Irredeemable preference shares. So our task is valuation. Valuation. First, we'll do the preference shares with maturity valuation. So valuation means it's common for the both preference shares, intrinsic value. Intrinsic value. Intrinsic value means PV of all future cash flows from that asset. Here it is what? From the redeemable. Redeemable preference share. A person who has purchased the redeemable shares might have two types of cash flows. Do you have any idea regarding these two types of cash flows? Just imagine you have purchased the one share from a Sampath bank which has a maturity, that is a preference share, for 100 rupee yesterday. Right? So then when you are trying to sell it on next Friday, the value is now the maturity time is only 7 days. You will be given the collected funds by the Sampath bank on next Friday. Right? So then what would be the amount is you have purchased this share for a 90 and then on Friday, next Friday, the company will take the funds to you, that is 100 rupees. Therefore, during 7 days, company will offer fixed amount of dividend 1 rupee. Just try to understand what sort of cash flows are related with these redeemable preference shares. Again, I will draw the concept here. We take the example Chalita. Right? Chalita, yesterday. Right? Yesterday, Sampath Bank. Sampath Bank. Sampath Bank issued preference shares yesterday. That means Friday, 27. So this company issue preference shares. Chalita purchase one share, right? One redeemable preference share. This case is regarding redeemable preference shares. The value of this preference share, again, it's like a paper, the preference share paper. So then the face value, we call it in the bond valuation also face value or the par value. Par value of this preference share is 100, the real value. Maturity period, right? 7 days. It might be happened. Anyway, just for example, 7 days. And then within this paper, they have mentioned your dividend is 1 rupee per share. Dividend is 1 rupee. Dividend is 1 rupee. Try to purchase this Sampath Bank preference shares yesterday for 98 rupees. What is the main transaction? The preference share passed from Sampath Bank to Chalita, and then this 98 rupee passed to Sampath Bank from Chalita set. This is the main transaction. If this is a main transaction, and then after 7 days, After 7 days, now Chalita is requesting money. Chalita is requesting money. Chalita went to the company, Sampath Bank, and then presented his one share, preference share, which preference share? Redeemable preference share. Redeemable preference share. And he asked 100 rupees. He asked 100 rupees. Why? The par value is 100. Company need to settle this 100 rupee at the end of the 7 days period. Then Sampath Bank, if the Chalita presented this paper to the bank, Sampath Bank have to give how much? 100 rupees to Chalita. Initially, paper passed from the company to the Chalita, and then 98 passed to the company by Chalita Sen. This is the first transaction. Second transaction, at the end of the maturity, or in this example 7 days, Chalita presented paper to the company, and then company have to settle the par value or the face value to Chalita. Right? Second transaction. During these 7 days, right? During these 7 days, company offer or company settle 1 rupee dividend. 1 rupee dividend to Chalita. 1 rupee dividend to Chalita. Hope the scenario is clear. Now this is dividend is the third main section. Right. So by looking at these 3 incidents, you can identify directly there are 2 types of cash flows. 2 types of cash flows. Future cash flows, not present cash flows, future cash flows. Right? What are the future cash flows that you can earn? This is 27th February. Right? If you are at here, 27th February, right? So what are the future cash flows that you can earn from this transaction? Or if you are investing in this preference shares, what are the future cash inflows that you can earn? Exactly. One is 1 rupee. What is it? You can earn 1 rupee. What is it? Dividend. The other one? Exactly. You can earn this 100 rupee at the end of the 7 days. So the 100 rupees. What we call this? This is the face value or the face value or which value? Par value, right? Par value of the preference share. Do we have other cash flows? No, right? If you invest, you have to bear 98 rupees to pay. But for the valuation, we are not considering the present commitment, right? So what we need is the 1 rupee dividend as well as the 100 rupee par value and maturity. If you want, write it down, face value or par value at the end. Dividend during the period. Clear. Now we'll customize the scenario. Just imagine the particular paper, right? This particular paper is for 7 years. 7 years. 7 years. And then for 1 year, Dividend is 1 rupee. 1 year dividend. 1 year dividend. Now tell me, other scenarios, other figures are constant. If we are looking at this number of years as well as dividend for this year, our third transaction dividend, 1 rupee dividend is going to be changed. How it is now changing? We have 7 years, right? During these 7 years, we might receive how many dividends? 7 dividends, right? 7 dividends. This year, first year, second year, third year, fourth year, fifth year, sixth year, and then last year, seventh year. First year, how much? 1 rupee, second year, 1, third year, 1, fourth year, 1, fifth year, 1, sixth 1, seventh 1. Now you can see here, not rather than 1 rupee, how many dividends? 7 rupee dividend. 7 rupee dividend, but occurring at different years. Different years, right? We know as per the time value of money, you have to consider what? You have to consider the present values of these future different 7 cash flows, right? That is why, as we did in the bond valuation, you have to take one by one present values in calculating the which value? The real value of the preference share. That is why I have taken the preference share valuation after the bond valuation. Even the lesson include the second part is ordinary share. Hope the basis is clear. Are you clear on this? So then intrinsic value, just will identify what are the 2 cash flows, right? These are future cash flows. So then regarding the preference shares, we have 2 future cash flows. What these 2 future cash flows are? First one, par value or face value, and the end of maturity, or else at the maturity. At the maturity. Please highlight par value at the end of the maturity or at the maturity. The other type of cash flow, what is it? Dividends. Dividends. Which dividend? Fixed dividends. Fixed dividends during holding period. During holding period. Please underline or highlight. Dividends are during holding period. Then, preference share with the maturity is clear. Next type is redeemable preference shares. Not redeemable, it is irredeemable preference shares. It doesn't have a maturity. If it doesn't have a maturity, again we also have to calculate intrinsic value. You have to value it, right? Intrinsic value calculation. Intrinsic value means again PV of all future cash flows. Future cash flows. Future cash flows. What are the future cash flows regarding this redeemable preference shares? Do we have a maturity? No. So then, do we have a par value? No. Only the value we have is dividend. Right? Based on that dividend, we have to value it. Right? Based on that dividend, we have to value it. All right. Then below it, write it down the valuation techniques, right? Valuation methods. I will take the next line. I will complete it. All done. Shakir, done. You can write it as a decision tree. If it is a maturity, if the preference share is having a maturity, how can we take the value? We have dividends. We have dividends. But dividends are acting as what? Annuity. So then to take the present value of all future dividends, you have to multiply the dividends by 1 minus 1 divided by 1 plus R to the power n divided by plus. At the end, we have power value, face value. It should be divided by 1 plus R to the power n. This is the present value of all dividends. And then this is the present value of PVR, power value. Power value and face value, same terms. The other one, irredeemable preference shares, value only, since we have only the dividends, fixed amount of dividend should be divided by the required rate of return R. It's the real value. If you want, you can rewrite the same dividend formula like this. This entire part can be rewrite. How can we? 1 minus 1 plus R to the power minus n minus n divided by this one R. Rather taking 1 divided by 1 plus R to the power n, this part can be taken to the upper side and mark it as a minus n. Okay, we'll go to the question number 9 then. Do the question number 9 and 10. Based on the redeemable preference shares as well as the irredeemable preference shares. Do we have a less number of students today? We have a quiz source, okay? You can do the question number 9 and then 10. I have updated the risk and return lesson also yesterday. That's the other. Mm. I was really busy yesterday there. So it's actually so important, man. Yeah. Big breath. Okay. You remember the next to our what do you call handle? Super. Let's measure. Is equals. Okay, so the answer is lower than 3. I suppose 30, no? Just started when not from you have started. So in Bhakti can do Shakti, you can sit next to. No, not basic. You can come here, otherwise you are not working. All right, so do I need to do calculations? Yes, right. Regarding the first one, value equals, we know the par value is 100, dividend 10 rupee or 10% for the par value, that is 10 rupee. You have to multiply this 10 rupee with the annuity factor 1 minus 1 divided by 1 plus R is 0.11 to the power 12 years divided by 0.11. The answer 6.490 around something. Then the present value of our par value is 100 at the end of the 12th year. So then converting that 12th year 100 to the present contains, dividing 100 by 1 plus 0.11 to the power 12. The answer is 28.58. Right? Both these answers 64.9 plus 28.58. The answer is 93.5. 93.5. Around this answer, the value equals. This is the answer for the example number 9. Then we move to example number 10. Example number 10. It identified about the irredeemable preferential value, right? Value of the irredeemable preferential. Right? How can we calculate the value? Until if it is irredeemable, it has only dividend divided by the required rate of return. Dividend is how much? That face value 100 multiplied by dividend rate is 15%. Divided by required rate of return, how much? 0.1. 15 divided by 0.1 reflect 150 for the irredeemable preferential value. Is that answer correct? So what you have to highlight when you are doing these calculations? Okay. But you need to actually highlight, the way of calculating the dividend, right? If you were not given the dividend in rupees, what is the way of calculating the dividend? Par value multiplied by the percentage. Par value multiplied by the percentage of dividend. Right. Are you all clear on preferential valuation? So then you can go to the basic mind map, go to the first page. Right, go to the first page and then please complete the mind map for the preferentials. Preferentials, two types of preferential, redeemable preferentials and the other one, irredeemable preferentials. So then please write down the basic formula. Value equals dividend multiplied by 1 minus 1 divided by 1 plus R to the power n divided by R. Plus face value divided by 1 plus R to the power n. If it is a irredeemable preferential, dividend divided by R is the value. Dividend divided by R is the value. So you can realize that, so same base, the valuation for the bond value and then the preferential value is something similar. That's why I have taken the preferential valuation after the bond valuation. Bond valuation, what are the two type of cash flows we have? Coupon payment and the other one face value. Preference shares, two type of cash flows, dividends and then the face value. Preference share dividends are normally similar to the bond valuation treatment in the where? Coupon payment. So those are similar. Coupon payment as well as the dividend payment. Dividend technical handling is same. By coupon payment also multiplied by the annuity. This is an annuity and then what happened? Preference share dividend also treated as the annuity. So therefore, way of measuring these two share, the two instrument, bond as well as the preference share is something technical as well as similar, technically similar, right? That is why I have taken after the preference shares, after the bond valuation, I have taken the preference share valuation. Dividends සහ coupon payments එකම විදිහට තමයි treat කරන්න මේ valuation වලදී. Right. So let's move on towards the ordinary share valuation. Okay, ordinary share valuation. Ordinary shares, right? Take down the heading, ordinary share or common share valuation. Ordinary share valuation, ordinary share / common share valuation. Okay, we discussed about what do you mean by the ordinary share, right? What are the basic characters of the ordinary shares? Those who have not present at that time, what are the two characteristics of the ordinary share? It has voting power, but it doesn't have a fixed dividend. But if you want, you can at whatever the point you want to sell it, definitely you can convert your ordinary share into the cash. That doesn't matter. But the case is, ordinary shareholders, they do not have the fixed dividend. Then the questionable, if they do not have a fixed dividend, how can we measure it? Right? How can we measure it? Yeah. Other people be cool. Okay. We read it. The valuation of ordinary share equity relatively more difficult than the other valuation technique because of two reasons. Right? What these two reasons are? These two reasons are the rate of dividend on the equity share is not known. That means dividend, we don't know it. Right? And then payment for the dividend is then it is optional. That is a decision of the board of directors whether we are going with the dividends or not in this time. Second reason is the earnings as well as dividends on the equity share are generally expected to grow. Right? Expected to grow. That means the dividends, they have a growth. Dividends, they have a growth. Right? They have a growth. Growth means dividends are having growth rates. We call that one as C. Right? So, sometime dividend is an optional decision. The other one, what is the other one? Last year dividend is not the this year dividend. This year dividend is not the next year dividend. It's changing. It's changing. Normally it is growing. Right? So because of these two reasons, we have to little bit take some technical concepts in evaluating the ordinary share or the common stock. By considering these two factors, common share valuation or the dividend valuation, the ordinary share valuation involves two methods. First one, dividend discount model. The other one, second method, price multiple methods. Right? First method, we can value the ordinary share with DDM, dividend discount model. The other one, we can value the share by using the price multiple. Right. So this taking the whether it is dividend discount model or price multiple model, that is the company's decision. Company's decision as well as, right, based on the availability of the information. Based on the availability of the information. Availability of the information, you can decide, okay, whether I'm going with DDM or as price multiple. We can't tell the investors or the companies, okay, you use the dividend discount model, right? We can't say that. Like why? We can't say that because that is based on the company's decision and then especially based on the availability of the information. Sometimes the time duration is available, sometimes dividend declaration involved. So then you can use dividend discount. Sometimes as an investor, you can't identify the future dividend, you can't identify the expected selling price. In that sense, you can go to the price multiple models, right? That is what you have to basically understood. You can write it down, common stock valuation, DDM, and then price multiples. We'll go to the method number 1. Take it down. Dividend discount model. Ordinary share valuation method number 1. Ordinary share valuation method number 1. Method number 1. Dividend discount model. Dividend discount model. DDM. Dividend discount model. Okay. So what this model identified, there are two cash flows, right? We know regarding the preference shares, we had two cash flows. Regarding the bond valuation, we had two cash flows. As same as, even it is not fixed, even it is not exactly having the future expected selling. Anyway, anyhow, regarding the common shares, we have two types of cash flows. First one, dividend payment. We know it is not fixed. And then the other one, at any particular time, we are trying to sell this share. So therefore, definitely we can identify expected. That means future. Expected selling price of this common stock, right? So these are the two cash flows regarding the ordinary share or the common share. So thus the value of the ordinary share, value of the stock can be calculated by identifying discounted present value of next year dividend payment and then the next period dividend payment, which is similar to the preference shares, as well as the bond valuation, dividend calculation, and then the coupon payment. Other one, taking the discounted present value of all future dividend payments. Right. Then. So if you are not clear on the previous thing, just remember this table. Right. Dividend discount model considered two important factors. First one, holding period of a share. Right? Holding period of a share. The other one, based on the growth rate. Based on the growth rate. Sometimes there might be information available to identify only the holding period as well as dividends during this holding period. If it is so, you have to consider the option number 1, which is a holding period technique. Right. So holding period might be a single holding period or more than 1 year. Holding period more than 1 year. This is holding period. If any particular investor keep it for a 1 year, how can we value? If any particular investor, ordinary share investor, keep it more than 1 year, how can we value it? Right? This is just to explain about the model, right? I will discuss this one by one. The other one, dividend growth rate. If the information is available regarding this dividend growth rate, zero growth rate, it doesn't have a growth, zero. And then constant, every year 5%. 5%, and likewise. If the growth rate is constant, if the growth rate is zero, if there are some different growth rate 1, growth rate 2, growth rate 3, and likewise, how can we? That is the maximum point where you can reach in this model. Hope it is up to certain extent it is clear. Dividend discount model considers two aspects. The first one, based on the dividend discount model, if you know the holding period, you can calculate the value of the share. The other one, if you know the growth rate, by taking the consideration of growth rate also, you can calculate the value of the share. Clear? එකක් තමයි ඔයා දන්නේ මේක ලොකු මොඩල් එකක්. මේකේ කියන්නේ ඒරියාස් දෙකක් තියෙනවා. ඔයාට කියනවා ඔයා දන්නවා නම් මෙයා තියාගන්න පීරියඩ් එක සහ ඩිවිඩන්ඩ්ස් ඒ අනුව අපි කැල්කියුලේට් කරමු. එහෙම නැත්නම් ඔයා ඒක දන්නේ නැහැ. ඔයා growth rate එක විතරයි දන්නේ. ඒ හා සමාන information විතරයි නම් දන්නේ. එහෙනම් යන්න growth rate consideration model එකට. That is what it identifies. Yes, you can write it down. Dividend discount model 1.1 holding period. 1.1 dividend discount model is a 1, then 1.1 holding period. It should be like this. Ordinary share valuation. Ordinary share valuation. Then point number 1, dividend discount model. Under that one, 1.1 holding period. 1.1.1 single holding period. Write it down. Single holding period. That's yeah. What is mean by single holding period? Don't look at the slide. Just tell me. Single holding period. Single one particular year. Right? You are purchasing a share to keep it for only how many years? 1 year. And then you are trying to sell it. So then you can have we know we might given the discount and then you might have the expected selling price. If you know if this is keeping for a 1 year and as well as if you know the dividends, what you can do as well as you know the expected selling price, it is very simple to calculate the value of the share by considering what? By considering what? Intrinsic value. That is what you have to always remember. But we are trying to calculate intrinsic value by taking this consideration of the concepts. How can we take? We know we might given expected selling price at the end of the first year P1. What do you mean by P1? Price of the stock in the next period. That means expected selling price. Or we know it. Required rate of return. Something new as well as you have to remember, take a highlighter and highlight it. When we are taking the present value of dividend, always dividend should be DIV or dividend we called as a DIV or dividend. Dividend in next year. Please highlight dividend in next year means year number 1. Year number 1. Next year dividend, year 1. So we call this one as what? Next year dividend. DIV1, write it down. This is called as next year dividend. Next year dividend. Next year dividend. O year 1 dividend. Year 1 dividend. Year 1 dividend. So then, just today received dividend. How can we write it? Today received dividend. D0. Write it. It is called as just paid dividend. Just paid dividend or current dividend. Current dividend. Can we take the D0 for the valuations? Can we take the D0 for the valuation? No. What is the reason? What's the reason? Today we receive the dividend, that is a present cash flow. Sometimes we might not receive that one, but we receive next year period dividend. So therefore, please highlight always when you are taking the valuation, right? You have to consider BIV1. So then, if I write like this, which year dividend? Dividend in second year, right? Dividend in third year. Dividend in fourth year. If we do not know the time period, it will be the dividend in nth year. D0, just paid. D1 next year, D2 second year, third year, fourth year, and like that. So this is the way of writing the dividends, right? D0 just paid. Don't take that. Sometimes the question will given you the just paid dividend, right? But don't take the just paid dividend. If we are taking the just paid dividend, that is wrong. Okay. You can do the question number 1. X4 BSAA expected to pay the dividend of 15 rupees at the end of the year number 1. Expected selling price of this stock is 355 at the end of the first year. Your required rate of return is 12%, but it does. What is the value of the stock? How can we calculate it? Since it's the first question, we'll write down. At the end of the first year, D1 equals 50. And then expected price of the stock at the end of the first year. That means E1. P55. P55. Then R is how much? Value equals. Dividend. Next year dividend, we just keep, if we draw this one in a diagram, right, we might have. So here we are. So then 355. At the end, take the percent value. Not only that one, we have 50 rupees. So then take the percent value. This is only 1 year, right? 1 year. 15 divided by 1 plus 0.12 to the power 1 plus 355 divided by 0.12 to the power 1. What is the value? 330. Am I correct? 330 rupees. Tell me if this is trading at 340. Now the value is how much? Value is how much? 330. Right? If it is trading at now 340, are you going to purchase or not to purchase? Real value is 330. But it is trading at 340 at the market. What is your decision? Are we going to buy or not to buy? Not to buy. What is the reason? Even the worth is 330, it is trading at market at the 340, which is under or overpriced. Overpriced at the market. Why? Real value is 330, but it is trading at 330. Value එක 330. මේක ගන්න ගියපම් කීයක් දෙන්න වෙනවද? 340. ඉතින් ගන්නවද? Right? So then you have to understand that concept also regarding the ordinary shares. Okay. So 1.2, what is it? Multi-period, right? Take it down. 1.2, multi-period valuation. Okay, now. Are you clear on this formula? What this says? Multi-period means you are keeping your share for more than 1 year. So then you might receive dividend in first year, you might receive dividend in second year. Just imagine we are keeping the share for how many years? 5 years. So then this is D0, D1, D2, D3, D4 and D5 plus we have 5th year selling price, right? Selling price in N means this is a notation, we don't know it. In particular example, this is P per. This is part of our Thank you. R is 10%. So then 0.1 to the power 5. So then we know we have to consider D1, D2, D3, D4 and D5. But they are present values. How can we take? 1 plus R to the power 1, 1 plus R to the power 2, 1 plus R to the power 3, 1 plus R to the power 4, last one, 1 plus R to the power 5. Then take the summation of these present values plus this expected selling price at the end. So this is what it says. Are you clear? Clear or not clear? Okay. This particular investment you a shareholder of a company and then you are trying to keep this share for 3 years. 3 years. If you keep this share for 3 years, definitely you will receive dividend in first year 5, dividend in second year again 5.5, and then dividend in third year, that is 6. And then your expected selling price at the end of the third year, that is 100. Right? How can we value? We have two set of cash flows. What these two set of cash flows are? First one, dividend. The other one, expected selling price. Value we know, value means present value of all future cash flows. V equals, right? V equals. We have dividend in first year, right? Just imagine required rate of return, that is 10%. Dividend in the first year, that occurs at the end of the first year, you have to take the present value, dividing it by 1 plus R to the power 1. Not only I have first year dividend, I have another 2 years dividend, D2 plus D3. So those things, present value needed to be considered in calculating the intrinsic value. So then, how can we convert those things into present context? D2 divided by 1 plus R to the power 2. Then, D3, 1 plus R to the power 3. First part done. That means consider the dividend present value. Not only the present value of dividends, we have the other payment, other receipt, that is what? Third year expected selling price divided by 1 plus R to the power n. N means 3. Why? This is occurring at the end of the third year. So then you have the two cash flows to value. This one, first one, present value of dividend, and the second one, present value of expected selling price. So this formula has been, we do not have the time period to write down all the years now. So therefore, this is the standardized formula. How can we write it? Starting from T equals 1. පළවෙනි අවුරුද්දේ ඉඳලා n වෙනි අවුරුද්ද දක්වා to the nth year. Right? Consider the dividends, present values. Consider the dividend, present value by dividing it by 1 plus R to the power T. T means it might be for 1 year, second year, and likewise. T, we don't know. And then PN means nth year. We don't know whatever the time period that the different shareholders are selling this different shares. So then we name it as a PN. We don't know the time period for that nth year. So therefore 1 plus R to the power n. So this is the standardized formula. Forget about the formulas. If you are very clear on the rationale behind this valuation of the multi-period, it is very easy to calculate the value of it. You can try on the question number 2. First, draw the timeline as well as name the figures in that timeline. So then it is clear. Marciansi. Now here you are something before out of that, some place are there that we have to I take 1,500. That is from this function. See, people goes and you then takes its individual dividend. This is that's the so divide and then next day also okay, so we'll quickly do it. Most of the students have completed it very structured manner and as well as with the proper answers. I will draw it. Okay. Today's it is trading at 75. Doesn't matter, it is present tense. Year 1, D1, 7.5, D2, 7.5, D3, 9, and then D4, that is 50. And then you were given, at the end of the third year, you are trying to sell it for 70. That means P4. P4, that is 70. How can we value? Right? Take the dividend first cash flow, and then take the present value of this expected selling price at the end of the fourth year. $7.5 divided by 1 plus 0.12 to the power 1 plus 7.5 divided by 1 plus 0.12 to the power 2, and then 9 divided by 0.12 to the power 3, and last one 15 divided by to the power 5, 4. Not only that, we have expected selling price, which is PN trading at fourth year, that is 70, 0.12 to the power 4, right? To the power 4. The answer is 73.01. Clear? Check whether the answer is correct or wrong. But it says, what is the value today, right? But it's given there. Now it is trading at 75. Now trading at 75. And then what the real value is 73. What is your decision now? Not to purchase or to purchase? Real value 73. But at the market that is trading at 75. Real value 73. But if you are trying to purchase this one, you have to give the 75. Do we need to purchase or not to purchase? Not to purchase because why? That is overpriced at the market. All right, we'll have a break for 15 minutes and you can come at 10:15. Discuss the dividend discount one. Hope the answers are very clear with the online students. So that if you have any questions, online students, if you have questions, please ask. How about your group assignment work? Started. Okay. So we start with the second model. That's a dividend discount model, second section considering the growth rate. Right, growth rate. Yes. Some companies, they have zero growth. Zero growth of dividends. Zero growth of dividends. Some companies, they might have, right, constant dividend growth rate. So which dividend we are discussing about? Ordinary share dividend. There are some other companies who offer, right, differential growth rates. Zero growth, right? Zero growth. Year dividend. Year one, dividend 5. Year 2, dividend 5. Year 3, 5. No growth, right? Even the year changes, dividend constant. This is the first case. Second case, constant growth rate. Constant growth rate. Dividend per year dividend. Year 0, starting from year 0, 5. Right? What you have to understand here, growth rate equals 0. No growth. Year 0, this particular case, year 0, 5, just paid dividend. Just paid dividend, but year 1, right? This year 0 dividend has been increased by with some percentage. We will take that one as 10. They are saying that first year dividend or year 0 dividend will be growing by 10%. 1 plus 0.1 to the power 1. What is the answer? That should be 5.5. Second year dividend. Second year dividend. Right? As same as first year, what happened? Just paid dividend, right? Just paid dividends are growing by 10%. 1 plus 0.1 to the power the answer. Take down the answer. Third year, right? Third year, what happened? Just paid dividend multiplied by 1 plus 0.1 to the power 3. Take the answer. Fourth year dividend, right? We'll take 10th year dividend. 10th year dividend, just paid is 0 multiplied by 1 plus 0.1 to the power 10. To the power 10. So this is D0, D1, D2, D3, and then D10. So you can see here what happened. Dividends are now growing. Dividends are now growing. Year 0, first year, second year, third year, fourth year, and 10th year. Starting from 5, first year, it marked as 5.5. Second year, it marked as whatever the amount. Third year, and fourth year, and 10th year. It's growing. It's growing, right? With the which value? Constant growth rate. If you want to identify, okay, we'll take the differences. First year dividend, 5.5. First year dividend, 5.5. Year 0, 5. First year dividend, 5.5. If you want to identify the difference or the growth of these, the first year and year 0 dividend, 5.5 minus 5 divided by 5. Tell me the ratio, please. What is the ratio? 10%, right? 10%. If you consider 3 and 4, again you are getting the same percentage. We call this one as what? Now the dividends are growing. Growth rate. Which growth rate? This is now constant. Last year 10%, this year 10%. Right? Next year 10%. Dividends are growing at a constant growth rate. Right? You have to understand the way of calculating the dividends if it is a constant. What is the formula? D0 multiplied by 1 plus growth rate to the power 10. So this is the way of calculating the dividends under the constant growth rate. And then important one is growth rate is constant. Now, is this clear? Clear? Still not clear. Yes, if you have any questions, you can ask. But you are not clear. Raise your hand if it is clear. What are the points that you are not clear? Saki. What are the points that you are not clear? Are you just writing down first? මොකද වෙන්නේ? සමාන්තරව evidence වැඩි වෙගෙන යනවා. Dividends are moving at a constant rate. Two point one. Do we have a growth? 2.1. Do we have a growth? In 2.1 scenario, do we have a growth? Dividends? No. Same dividend. But in the constant model, what happened? Increasing with the which percentage? Constant percentage. Right? It's not at the same. You can calculate D1, D2, D3 and D10. So then it is clear. Calculate D1, D2, D3 and D10. We can go to the quiz after the second session. You do not have lectures on page 6 today. You don't have lectures on page 6 today. No, no. It's not. 30 minutes. Okay, no? He said okay, no? Okay or not okay with you? No, we don't. After 3:30. Fine, no? Anyway, you have time for the your evening. Yeah. Anyway, I asked Miss Ashanika to put the 3 to 6 session to business finance, and then after I realized you will get confused on business finance after you have 3 sessions. That means 9 hours, no? But anyhow, we have missed 1 session. First day. D1, how much is it? 5.5. D2, 6.05. D3, D3, 6.6. 5. D10, 12.996. Right. Have you all got the same answers? One plus 0.1 to the power 1. So let me see. The person next to you always is missing, right? The next person. Yeah, the next person. Now she's done. Then hope you all have calculators today. That is a voting calculator. Right. But yours? So we'll go to the calculations example number. Zero growth clear, right? Now below it, write it down, right? If it is a zero growth, how can we calculate the value? Value equals dividend divided by required rate of return, right? Same diagram. Please continue. Below the zero growth section, please write down the valuation technique. If any share, it has a zero growth, right? If it has a zero growth, right? How can we value the share? Dividend divided by the required rate of return. Required rate of return. Okay. Do the question number 3. Value equals dividend divided by required rate of return. Tell me, here do we need to consider the DIV 1 or DIV 0? Yes or no? Always I told you that when you are valuing, it should be DIV 1. Right? Next year. But here Is that DIV1 or DC? Doesn't matter. Why? Same. Right? Dividend is 5. Even it is might be a 10th year, dividend is 5. So there are no differences in between the dividends during year 0 and year 1. So therefore, whatever the year dividend, if you take, that gives the same answer. Dividend function, let us subtract dividend. Because why? It's a 0 difference. Right. You can do the question number 3. Keep that page as a blank page and then go to the next page and start it. Right? At least to discuss the differential growth rate, please keep 15 rows or 16 rows and then go to the questions one by one. Okay, we read the question. Coco PSC has just paid dividend 6 for the last year and expected to remain the same dividend payment throughout the coming period. Look at here. If you have the highlighter and note, please highlight. Same dividend, right? Same. Same dividend means what it reflects. Same dividend means what it reflects. Very good. That is 0 growth. No growth, right? 0 growth. If the required rate of return for the investor is 12%, determine the present value of the common stock. We know value equals dividend divided by required rate of return. Dividend is 6 and then required rate of return is 12. The answer is 50 rupees. 50 rupees. Okay. Then we'll go to the question number 4. But after discussing the valuation technique, coming under the constant growth model. Now go to your main note. Right? Main note 2.24. The valuation of, right? The valuation of common stock under the constant model. How can we value? The cash flow we have here is the dividend, right? But here you have to consider which year dividend. Dividend in the first year. Because why? There are some differences in between the dividends during the holding period, right? Dividend divided by dividend in the first year divided by the difference between D1 or DIB1, the difference between required rate of return and then the growth rate. Required rate of return and then the growth rate. It gives us the value for the ordinary share. R G means constant growth rate, R means required rate of return, DI means dividend in the next year, and value means present value of the common stock. Example number 4. Read the question. Company paid dividend 7 rupees, but that is which dividend? Just paid dividend. Once you see the word just paid dividend, you have to highlight and mark it immediately. That is D0. D0. So then otherwise you get confused or get wrong answers with the dividend in the first year and just pay dividend. Last year for the expected to increase the dividend by 5% each year. Each year constantly increasing the dividend by 5%. So then 5% means what? 5% means that is the exactly what is it? Differences between growth rate reflect what? That is the way how the dividends are growing, right? 5% annually dividends are growing, right? Then growth rate is 5%. Required rate of return for the investor or its current market interest rate is how much? That is 10%. It has value of the common share, right? This is R. Just pay dividend, highlight please. Just pay. Or the last year. Last year, how much is it? That is D07. Growth rate. Each year payments will be growing by 5%. Growth rate 5%. Growth rate 5%. Okay. Shakir, tell me the calculation for the present value. Value equals good. Yes. DIV divided by the difference between R and growth rate. We were given the DIV 0 or D0. How can we convert this D0 into DIV 1? Exactly D0 multiplied by 1 plus growth rate to the power 1 divided by R minus G. D07 multiplied by 1 plus growth rate is 0.05 to the power 1 divided by R is 0.1 minus 0.05. How much is it? 147. 147. 147. Well, okay. Are you clear on this process? Good. Next topic, differential growth rate. Differential growth rate, we'll take it to the next session. Okay. So hope it is clear. If you have any questions, you can ask. Online students, do you have any questions? Good class. If you mark the attendance.